Let me say a few words of introduction to give viewers a sense of what to expect over the balance of the session. The name is very descriptive. We'll be focusing solely on interest rate swaps and credit default swaps. Two of the more important over-the-counter derivatives used by participants in the fixed income market especially, but a variety of other financial markets as well. Just to address briefly a little bit about my background, since Paul threatened you with that. While I have been an independent trainer and consultant for about the last 20 years, I spent the first 20 years of my career on Wall Street bouncing back and forth between the trading and training side of the business. So that while I've worked on bond trading desks and managed equity and debt portfolios, as well as been in a variety of sales positions, I've also have extensive experience presenting on these topics, having managed training units, both for brokerage firms, for instance, both Citibank's private bank and U.S. retail broker-dealer, as well as organizations like the New York Institute of Finance. So without further ado, since this is a very ambitious agenda, as most of mine are, let's dive right into the discussion of the two sorts of swaps that will be the subject of today's session. The session will be split about 50-50 between interest rate swaps and credit default swaps. In each half of the program, I will start out with a brief overview of the type of derivative under discussion, either the IRS or the CDS respectively. And after giving a brief introduction to the derivatives themselves, then go into a little bit of detail about the contract specifications, after which we'll do a simple illustration by walking through a risk management or trading situation for each, and then step back and look at a broader swath of a range of applications, either for positioning or risk management, as well as a little bit on at least the conceptual aspects of pricing and valuation. So with that as an introduction, let's begin the discussion of interest rate swaps. Now, swaps are always over-the-counter contracts as opposed to exchange traded. And the implications of that is that the contract terms are potentially negotiated between the two counterparties. I say potentially because more and more you see the adoption of ISDA, that is the International Swap and Derivative Association, standardized contracts being used as a way of minimizing the necessary legal review and associated cost. But I'll not focus on the standardized contracts, as that complicates the discussion of the basic features of the contracts, because while the standardization makes for greater efficiencies in trading and clearing, it complicates the explanation of the contract. So we'll be talking about basic bilateral contracts, which are still used. It's just that more and more they're being displaced by the standardized contracts. But again, the key features are swaps are always over the counter, and potentially all elements of the contract are negotiated by the two counterparties. And it's important to realize that any time a swap is entered into, what being exchanged between the counterparties are market exposures. Now, if you've listened to any of the earlier presentations, I've defined exposure in more detail, so I'll just do it briefly here. But by exposure, I mean one has a position in the market, and given a position in the market, that means there's capital at risk. And consequently, if once one has exposure, the market moves in a way that benefits one's position, there's a capital gain. Or if the market moves in a way that disadvantages one position, there's a capital loss. So always when swaps are entered into, the counterparties are exchanging market exposures. Now, whether that swap exposure increases or reduces overall exposure in the market depends on pre-existing positions. And we'll address using swaps both to create exposures, which is oftentimes done, what's sometimes called positioning, but probably to an even greater degree, swaps are used to manage existing exposures. But while the swap creates exposure in a mechanical sense, the capital gain or loss that results from the exposure that I addressed earlier is to a very large degree recognized by periodic settlements, where the value of the two legs of the swap, I'll be more definitive about what I mean by legs of the swap in just a moment, but there'll be a computation of the value of the two legs periodically, and the counterparties will make an adjustment in money to recognize the change in the value of the exposure over the previous settlement period. Here you see sort of a standard illustration of a swap contract. These are referred to as box diagrams, I guess for obvious reasons, since the positions of the two counterparties are represented by boxes. And I'm starting out with this maybe not best of all possible diagrams because it is one you are likely to encounter at the beginning of any introductory level book on swaps. So there's an exchange of, or at least the contractual commitment to pay the streams of service payments. Now that's the formal name. More colloquially, those are what I earlier referred to as the legs of the swap. And even though it's showing service payments going in both directions, in the vast majority of cases, what's happening is a simultaneous net settlement, which we'll see illustrated in a couple of slides forward, where periodically the value of the two legs, the two streams of service payments, are calculated. And then there's simply a payment in a single direction. In a standard interest rate swap, you'd compute the value of the two legs, determine what is the difference between the value of the two, and whoever owed the larger amount will have to pay that difference. And if that verbal explanation was a little bit hard to follow since it went quickly, not to worry, we'll see a very simple number example of that in just a moment. But my earlier comment about this perhaps not being the best or most ideal diagram, I made that comment because in nearly all cases, one of the counterparties to the swap will be a swap dealer. So that when the market first evolved back in the early 1980s, typically the banks or brokers acted as finders. They'd bring together two different clients that were going to take the opposite sides of the trade. So in those original swaps 35 years ago, both counterparties were typically using the swap for risk management purposes. Nowadays, in nearly all cases, since it has become primarily a dealer market, one of the counterparties to the swap contract will be a dealer. And the dealers in general are not using them for risk management purposes, at least in the main. They're trying to make money by providing liquidity and making the effective equivalent of a bid-ask spread. So in all subsequent interest rate swap diagrams, I will have a dealer on one side or the other of the trade. Now, while there are a wide variety of possible structures, since this is an introductory level session, we'll talk about the most basic form of an interest rate swap, which is the standard fixed for floating interest rate swap. So for those that saw the introduction to derivatives a couple of weeks back, interest rate swaps are a type of forward commitment contract where both counterparties to the contract are incurring a legal obligation, a contractual commitment to do something. So in the plain vanilla fixed for floating interest rate swap, one counterparty is committing to pay a fixed rate of interest to the other. The party receiving the fixed rate is promising to pay a floating rate. Now, unfortunately, you can use a variety of language. You can talk about the fixed rate payer, who is also the floating rate receiver, or the fixed rate receiver, who is also the floating rate payer. And either phraseology can be used, although to minimize misunderstanding, usually the terminology is standardized around describing who's on what side of the fixed rate leg. And excuse me that GoToMeeting kicks me out every time I try to do that, so let me get back into presentation mode here, but I did want to do a little bit of drawing here. Yeah, I guess we're going to have to draw in this in this mode. All right, so it turns out that on the standard form of the swap contract, that they will also occasionally use the terms long and short. Fortunately, not all that often, but for what it's worth, the fixed rate payers, the party that's deemed to be long the swap, the fixed rate receiver is the party that's deemed to be short the swap. So fortunately, that terminology, which is relatively obscure, is not commonly used, but you do occasionally encounter the phrasing, someone being long or short the swap. And it has to do with who benefits by the way interest rate changes. In general, when you're long, you benefit when something goes up in value. And naturally, since this is an interest rate derivative, the party paying the fixed rate but receiving the floating rate benefits in a rising interest rate environment. So consequently, the fixed rate payer is the party that's deemed to be long the swap. But as I indicated, that's less commonly used terminology. In the vast majority of cases, they'll talk about who's the fixed rate payer and who's the fixed rate receiver, at least when one is discussing interest rate swaps. So here you see a more typical setup where one party is using the swap for risk management purposes and they're trading with a dealer. And I don't mean to imply that the party using the swap for risk management purposes is always paying fixed and receiving floating. They're just as likely to be on the other side of the contract, but a subsequent illustration of a risk management application is going to be looking at it from the perspective of a corporation that's paying fixed and receiving floating. And so that's why this particular example was used as a more realistic illustration of a box diagram that has a dealer on one side of the contract. So what are the terms of the contracts? So the contract is negotiated between the two counterparties, and what they have to agree to is the notional amount, that's the size of the contract. In US dollar interest rate swaps, that would be expressed in dollar terms. It's analogous to a par value of a bond, but it's called notional value here because it doesn't represent an actual exchange of money. You might wonder then, well, why do we need a notional amount if it doesn't represent an actual exchange of money? Well, of course, since the two legs are expressed in terms of some interest rate, to be able to calculate the dollar value of the legs, or more importantly, the dollar value of the difference between the interest rates on the two legs, you need some face amount and term, length of time to apply it to, and that's one of the consequences of notional amount. But in a more substantive sense, the notional amount also represents the amount of market exposure you're trying to create or offset. The length of the contract is referred to as the term or tenor or time to maturity. Most interest rate swaps, excuse me, probably have tenors at their initiation of between 2 and maybe 7 years. They can be shorter, although they're usually not real short term, the way equity swaps are oftentimes 3 or 6 months or a year or less anyway. But interest rate swaps can be much longer tenored. In fact, it's not uncommon to see 20, 50-year swaps, interest rate swaps. I've even seen 100-year interest rate swaps. But again, the vast majority are probably between 2 and 7 years, but they can be significantly longer. Settlement frequency, well, that is primarily a function of the sort of exposure you're trying to create or offset. The most common settlement frequency on US dollar interest rate swaps is quarterly, at least for the floating rate leg. And that's why 3-month LIBOR is by far the most common index rate used to establish the value of the floating rate leg. Because though it is not required by law or regulation, for most real world exposures one would be trying to manage the risk of, it would normally require that the term of the rate be consistent with the length of the settlement period. So contracts settling semi-annually would typically be based on a 6-month rate, contracts settling monthly on a 1-month rate. But again, as I indicated earlier, the most common settlement frequency for the floating rate leg on US dollar interest rate swaps is quarterly, which is one of the reasons for the very great importance of 3-month LIBOR. And while there are many extensive contract terms that have to be negotiated, mechanical things like how the monies will be exchanged on settlement dates, if there's a legal dispute, under what law would it be adjudicated, New York law, London law, whatever the case may be. We're going to focus on the economic aspects of the contract. So the other important elements of the economic aspects are the interest rates associated with the two legs. And again, since we're talking about a plain vanilla interest rate swap, the fixed rate leg will have its value based on a fixed coupon rate. And the floating rate leg will be based on the value of some index rate. Now, I referenced 3-month LIBOR before because it is the most common rate, but whatever rate the counterparties agree will be the index rate that would be used to establish the value of the floating rate leg. So here we see the box diagram with a little bit more detail. And I'm assuming for this example that the fixed rate leg has a coupon rate of 2.58%, and the floating rate leg is based on an index rate of 3-month LIBOR. So when you have a bilateral contract, and again, because of the change in the business and the aftermath of Dodd-Frank, the vast majority of interest rate swaps are now cleared. So you'd end up, after a swap is negotiated between two counterparties, those exposures being transferred to a clearinghouse. But again, because we're trying to keep it simple and focus on the basic economic aspects of the contracts, I'll use a plain vanilla bilateral contract to illustrate the features because they're more understandable and easy to follow in that context. And there are still bilateral contracts, by the way. I don't mean to say they're not used any longer, because any organization that qualifies for a commercial exemption does not have to have their swap introduced to a clearinghouse. So while most swaps are cleared, a significant portion of the interest rate swap market is still made up of bilateral contracts, as is illustrated here. So when you have a bilateral contract and you come up on a settlement date, we're assuming quarterly settlement in this case, then the dollar amount of the settlement payment would be based on the difference between the dollar value of the two legs. So whatever the frequency was, monthly, quarterly, semi-annually, annually, we're assuming quarterly here again, at the designated time, you'd compute the value of the two legs, and the settlement payment would be equal to the difference between the value of the two legs. And that's what's referred to as a simultaneous net settlement. When the market was first evolving back in the early 80s, one counterparty would pay the leg they owed in full and then wait to get in return the leg they were due. Of course, when you had a separation of the settlement like that, whoever paid first had increased counterparty credit risk exposure. And that's why the market rapidly moved to a simultaneous net settlement within a year or so of the swaps first evolving. So let's see a simple number example. So what's assumed is shown at the bottom of slide number 8. You see again a reprise of the fixed rate leg coupon rate of 2.58%. I was assuming an index rate 3-month LIBOR of 0.26%. I put this exhibit together a year and a half ago, which is why LIBOR is a bit below where it is currently. Probably currently it's closer to 75 basis points. I'm assuming a notional value of 150 million. The vast majority of interest rate swaps will have notional values in the tens or hundreds of millions, or even in excess of $1 billion. The swaps market is very large. And so the typical swap, as I say, is in the tens or hundreds of millions. So this would not be an unduly large size swap. And I'm also assuming that in this case there are 91 calendar days in the settlement period, in the quarter. Of course, that's arbitrary. It would depend on the start and end dates of the quarter. And depending upon the start and end dates, the length of the quarter could be anywhere from 88 to 93 calendar days long. And as we'll see, there's some implications about the number of days and the value of the two legs. Across the top of Exhibit 8, you see the formula for calculating the value of each leg. In each case, it's the appropriate interest rate, the fixed coupon for the fixed rate leg, and the index rate for the floating rate leg. In both cases, times the notional amount, and in both cases, times the appropriate number of days divided by 360. Now, it turns out both legs assume a 360-day year, but as we'll see, the numerator in the length of the settlement period will differ for the two legs. And here you see on the following page, the fixed rate leg, there's 2.58% in decimals, 0.0258 times 150 million notional. Note times 90 divided by 360. It might seem a fine point, and certainly it doesn't matter for the general concept, but mechanically it matters. So that the fixed rate leg uses a corporate day count convention, which is 3360, which means by assumption every month is 30 days long and every quarter is 90 days long. On the floating rate leg, on the other hand, you see the index rate 2.26% or 0.0026 in decimal terms times the same notional, but now times 91 divided by 360, because it turns out the floating rate leg uses money market conventions, which is actual over 360. And we'll see some of the implications of this later, but I'll hold that off until we see a later slide. But you can see the dollar value of the two legs, and at the bottom there's the finding of the difference between the dollar value of the two legs. And since the corporation was paying fixed and receiving floating, and the value of the fixed rate leg was significantly larger, at that settlement date the corporation would have to pay the dealer the difference between the dollar value of the two legs. Now, let's put this in context, because that's not that that was an inappropriate illustration, but it was just the calculation of settlement payment. Let's try to increase one's understanding of some of the uses of interest rate swaps by looking at a risk management application. Though we'll discuss others, and swaps are nowadays oftentimes used to hedge value, they were initially conceived of ways of managing cash flow risk, and specifically cash flows related to liabilities. Although, as we'll see later when we do a quick overview of a range of different applications, they can be used to manage cash flow risk on assets or liabilities, as well as hedging value. But in this case, what we'll do is show how a corporation that had funded itself with a floating rate note issued some time ago is now concerned about rising interest rates resulting in increased interest expense, and wants to use a fixed for floating interest rate swap to convert that floating rate note into a synthetic fixed coupon bond. In other words, fix their net interest cost using the interest rate swap, despite the fact they might actually see rising interest rates going forward. And what we'll show in the following illustration is that by matching up the terms of the swap with the previously issued floating rate note, we can achieve a net fixed interest cost from the corporation's perspective. Now that's brief on this page, but it might be more helpful to look at the picture while I'm describing the details here. So to the left-hand side of this exhibit, we see the corporation that I'll assume had issued a 20-year floating rate note 15 years ago. That would have been a good call, of course, because interest rates are generally lower today than they were 15 years ago. But if they issued a 20-year floater 15 years ago, that means 5 years remain to maturity. And if the note is not callable, that means if interest rates were to rise over the next 5 years, the corporation's interest expense would rise in tandem. Well, what they would like to do is enter into a fixed for floating swap, such as we have illustrated here, and you'd want to negotiate the terms of the swap so that they match the terms of the outside exposure, in this case the floating rate note. Remember before we talked about a notional amount? Well, I assume that the notional amount of the swap was $150 million. Why would we want to do a $150 million notional swap? Well, presumably because that's also the par value of the floating rate note. I didn't discuss the term, but let's say that since I assumed it was a 20-year floating rate note issued 15 years ago, that means 5 years would remain to maturity. Well, in that case, we would like to negotiate a swap that has a tenor of 5 years from today. We assumed that the swap before had an index rate of 3-month LIBOR. Why 3-month LIBOR? Well, presumably because the index rate that the floating rate note coupon is based on is also 3-month LIBOR. The corporation would not want to negotiate an index rate based on 3-month LIBOR simply because that was the common rate or the most widely used or popular rate. They'd want to negotiate terms of the swap that match the terms of the outside exposure. And remember I said not just the index rate 3-month LIBOR, but the implication was also quarterly settlement. Why would you want a quarterly settled swap? Well, presumably because the floating rate note paid its coupon rate quarterly. In fact, not only would the corporation want to negotiate a swap that has the same index rate and settlement frequency, they would like the index rate of the swap to be reset on the same day as the index rate is established for determining the floating rate note coupon. Because if they reset on different days, they could reset to different values. Now, the problem isn't that they reset to different values. If they reset to the same differential at every reset, risk would be managed just fine. The problem is they wouldn't always reset to the same differential. Consequently, the corporation would want to negotiate with the swap dealer a reset date for the index rate that's used to establish the value of the floating rate leg of the swap that's exactly the same date as the reset date of the index rate used to determine the floating rate note coupon. If all those things match as I just described, par value of the, or I should say the notional amount of the swap is the same as the par value of the floating rate note. The tenor of the swap is the same as the time to maturity on the floating rate note. The index rate in both contracts is exactly the same and resets at the same time. If all those things match as I just described, that would mean that the streams of value represented by the cash flows the corporation owes to the floating rate note holders and the value of the floating rate leg, those two streams of value would be exact economic offsets to one another. Consequently, that would leave the corporation with a fixed interest rate equal to the fixed coupon on the fixed rate leg of the swap plus the spread they're paying to LIBOR on the floating rate note. And that's what's illustrated off to the side of the diagram here. The corporation, in effect, would have fixed the interest rate they're paying. And by combining or looking at the net cash flows on the fixed for floating swap with the floating rate note, they're going to have exactly locked in the interest expense they're paying over the remaining life of the note, since the tenor of the swap matches the time to maturity on the floating rate note. So note the interest rate the corporation would have locked in. They would have locked in as their net interest expense the 2.58% on the fixed rate leg of the swap plus the 115 basis point spread to LIBOR. And so it looks like a net interest cost of $373. Now, it turns out it wouldn't be exactly $373, and that's where the difference in day count conventions comes in. I'm not going to linger over it since it's relatively involved, but for those that really want to understand the detail, I have it worked out precisely on slide 14. So because of the difference in day count conventions, the corporation actually would be locking in 375, not 373. And it might seem like, oh, what's a couple of basis points? But remember, the size of these contracts is typically in the tens or more commonly hundreds of millions or even billions of dollars. And even a couple of basis points turns into significant money at that point. Now, we're not going to spend a lot of time with it, but just so one has a general idea, we'll talk about both pricing and valuation of interest rate swaps very briefly. And while pricing and valuation might sound like two ways of saying the same thing, it isn't to people in the interest rate swap, or more generally swap business. Pricing means setting the terms of the contract at its initiation. Valuing a swap means determining what it's worth sometimes after it's been created. So let's first focus on pricing. And for an at-market swap, which in the parlance of the business today is referred to as a par swap, that means the contract is set up so it has an initial value of 0. Now, to have an initial value of 0, that means the present value of the cash flows associated with the two legs must be approximately the same. And you might recall that in our example that the fixed coupon rate was 2.58%, and the value of the floating rate leg, at least for the first period, was 0.26%. But note that 2.58%, that's fixed over the next 5 years. the interest rate that the floating rate leg is based on will vary quarter by quarter by quarter as it resets. So how could we know that the present value of the cash flows associated with the two legs would be exactly the same when we have one leg that's fixed over the entire 5 years and the other leg that will vary period by period by period? Well, a detailed discussion is way beyond the scope of what we have time for here, but one of the ways the dealer could hedge its risk is by going short euro-dollar futures, which is a type of futures contract that's based on 3-month LIBOR. And it turns out by shorting the appropriate number of contracts for the appropriate settlement dates, in effect, the dealer could lock in the rates they're paying for not the first period. They don't have to hedge the first period because the first period rate is set at the initiation of the swap. The short euro-dollar futures positions would be hedging the next 19 resets, and I say 19 because this is a 5-year quarterly settled contract in the example. And the 2.58% in effect represents a sort of weighted average of the current spot rate plus all the forward interest rates that could be locked in via the appropriate hedging strategy. That's how we can know the present value of the two legs are equal, because we're determining the fixed coupon in the fixed rate leg by the rates we can lock in over the life of the contract. Now that was pricing. What's valuation? Well, valuation means terminating a swap early, or if it's a cleared swap, like futures contracts, their value, that is marked to market daily and results in a daily settlement, a cash flow that reflects the change in the value from one trading session to the next session. And it turns out valuation is done on what they call dual curve pricing, because you have to look at the cash flows over the remaining life of the swap. And those you will project using LIBOR, of course not for the fixed rate leg. The fixed rate leg is fixed by the coupon, but you could lock in the cash flows on the floating rate leg using euro-dollar futures. And then once you've projected the cash flows on the floating rate leg in that fashion, the cash flows on both legs will be discounted at a rate that's established from the OIS, that is the overnight index swap rate. And well, if anybody really wants to see the mathematical models, send me an email via Starweaver, and I can refer you to some websites that show you the god-awfully complicated models that are used to value swap contracts. And then finally, just a word about applications. What we went through in a little bit of detail just a few moments ago was how to convert a floating rate liability into a synthetic fixed rate liability. But you could also convert fixed rates into floating rates on liabilities. You can also do the same things with assets, convert a fixed rate asset into a floating rate asset, or a floating rate asset into a fixed rate asset. And while those were the sort of the initial applications, as soon as the market became liquid, you also started seeing both portfolio managers and security dealers use interest rate swaps as hedging vehicles to hedge value. So for instance, corporate bond portfolio managers might prefer to hedge their corporate bond portfolios using interest rate swaps rather than treasury futures, because that will minimize spread risk. Mortgage-backed security dealers, in fact, will oftentimes hedge their inventories using interest rate swaps, again, because of issues related to spread risk. And you can even create market exposures. Hedge funds will oftentimes establish a position to bet on interest rates going in one direction or another by using interest rate swaps. Well, it's time to move on to credit default swaps for the balance of the session. So credit default swaps. Now, even though they share a word in the name of the contract, swaps, with the IRS we talked about previously, for those that saw the introductory session on the derivatives suite of webinars, you might remember that all derivative contracts can be categorized as either forward commitment contracts or contingent claims, and interest rate swaps fall into the first category forward commitment contracts. Credit default swaps fall into the second category, contingent claims. And as we'll see, although we won't have time to go to it in great detail, credit default swaps are much more analogous to options than they are to the other swaps. Now, one of the unique features of credit default swaps is they were the first contract that allowed one to take a pure bet on, or either a pure bet or a way of managing purely credit risk, because all previous sorts of derivatives were typically tied to interest rates in general, and interest rates change for a lot of reasons, having to do with supply and demand for capital, inflation expectations, and the like. So the advent of credit default swaps was the beginning of derivative contracts that allowed the pure hedging or pure exposure to changes in the market's perception of credit risk. So while the primary purpose of CDS is to manage credit risk, they also gave us a way of pricing credit risk, again, because of the pure exposure to credit risk that one is taking with a credit default swap. But as we'll also see, they're a way of those using swaps for positioning purposes as opposed to risk management as a way of gaining exposure to asset classes as an investor. It turns out that that's not by buying, that's by selling credit protection. One would be gaining at least the equivalent or sort of equivalent to long asset exposure. And as we get further into this, we'll discuss the advantages of using CDS versus other instruments for a variety of reasons. So here you see the equivalent of the box diagram we saw for interest rate swaps earlier. And these are a bit more rectangular than boxy because of the longer descriptor. And you'll note I haven't called one of these a dealer. And that's because parties using credit default swaps, or CDS for short, are just as likely to be sellers as buyers of credit protection. And another difference here is you'll note that I've got a solid arrow versus a dashed arrow going in the different directions. The party buying credit protection will have to make periodic payments. Now that's not the official name. More typically, the payments are referred to as either the CDS spread or the fixed coupons, or sometimes premiums, although that last is probably less common than the first two. But the buyer of credit protection, in a sense, is buying sort of like insurance against credit risk exposure. And what do they get in return? Well, again, as is the case when buying insurance, one never knows whether they will collect on the insurance policy. Ergo, the dashed line with the question mark associated with it. Because much like when one buys insurance, if one buys, say, homeowner's insurance, you get protection from fire damage or being burgled or things like that. Well, what happens if there's no fire or you don't get burgled? Well, of course, you never collect on the insurance in that case. You simply have the peace of mind of knowing that had some adverse event against which you had bought insurance occurred, you would have been compensated to some degree. And credit default swaps are very analogous to insurance in that sense. But note I said analogous to insurance. Specifically, credit default swaps are not insurance contracts. In fact, the U.S. Congress passed a law that said that credit default swaps cannot be regulated as insurance. Now, you might wonder why a government would pass laws that limits its own actions. Well, Congress might have an interest in reining in regulators, but in this case, it specifically concerns about state regulators, because the U.S. has dual regulation for both securities and derivatives at both the federal and the state level. And the federal government did not want the states regulating credit default swaps as insurance, because that could greatly limit market participation. In general, you can only buy insurance if you have an insurable interest. Just to illustrate the idea, it creates very bad incentives if you can buy life insurance on anyone you prefer. Of course, you are able to buy life insurance against someone in which you have an insurable interest, like a spouse or a parent or a child or even a business partner. But if you could buy insurance on a rival, You could do so and then hire a hitman to knock the rival off and get a twofer. Get rid of a rival at the same time you realize a financial gain upon their demise. Same thing if you could insure property that belonged to someone else. So generally, to buy insurance, you have to have an insurable interest. There is no similar requirement that one own a bond that one is buying credit protection against. And there's a variety of reasons for that, permission. But in general, it's because the more ready buyers and sellers you have, the more efficient the market is in terms of ease of entry and exit of positions, i.e. liquidity, as well as pricing the risks or exposures that the contracts relate to. So to illustrate the idea in context now, why would someone want to buy credit protection? Now, in this case, you see in front of you the buyer of credit protection paying either the CDS spread, that would be on a negotiated contract, or the fixed coupon rate on a standardized contract, and they may or may not get any payment return. Now, why were these contracts conceived? Well, initially the idea was that the buyer of credit protection might want to buy credit protection on some bond that might have its value adversely affected by some adverse credit event. Now, I'm using the terminology here that you're likely to encounter in a basic reading on credit default swaps. So long the risky asset, in other words, long they own the risky asset, but understand risky asset doesn't mean like a high yield or a junk bond. Risky asset is just the general terminology that's typically used in writings on credit default swaps that relates to any bond whose value could be adversely affected by a credit event. In other words, those could be U.S. government bonds or Japanese or German government bonds. Bonds that have some of the lowest credit risk in the world, nonetheless would be referred to risky assets in the context we're talking about here. Well, if I'm long a bond issued by some corporation or government, and I buy credit protection on that bond, or on that issuer, I should say, that's what's known as a single name CDS, well, then in that case, I'm long the bond, but my credit risk is protected or hedged by purchase of the CDS, and so you could refer to that as a credit hedged investor. And that way, if the risky asset declined in value due to some credit event, like the declaration of a bankruptcy or a failure to make payment of a coupon or retire a bond at maturity, well, in that case, the buyer of credit protection would receive a settlement payment whose value would approximate the decline in value associated with that adverse credit event. CDS contracts, like interest rate swap contracts, will have many terms, and again, there'll be many we'll not discuss here related to sort of the operational or back office considerations or legal considerations. In other words, how the money's moved around and under what the laws would any disputes be adjudicated. We'll focus on the economic aspects of the contracts. So there'll be a notional amount again. Now, in this case, it represents, in a substantive sense, the amount of credit protection the buyer is seeking to acquire. And then in a mechanical sense, the notional amount is also going to be used to determine the dollar amount of the periodic payments. And I say periodic payments because normally these are payable on a quarterly basis. So one is either the spread or the coupon is expressed as an annual rate, but then you'd compute the quarterly value of that annual rate by multiplying the rate in question, the spread or the coupon, times the notional amount, times the number of calendar days in the quarter divided by 360. Yes, and I said number of calendar days divided by 360 because that's the day count convention they use in the CDS market, actual over 360. Again, there'll be a tenor or term. The vast majority of interest rate, I should say credit default swaps, are standardized contracts, which are normally 3 or 5 year contracts. Now note, I didn't say between 3 and 5 years, I said 3 or 5 years. Counterparties can negotiate any length of contract they prefer, but the vast majority of CDS are either 3 or 5 year contracts because those are the two standardized lengths under the ISDA standardized contracts. There'll be a payment frequency, and again, it's whatever the counterparties negotiate, but it's normally quarterly. And in fact, in the standardized contracts, there are set dates. It's going to be the 20th of each of the quarterly months, every March, June, September, December. And then whether or not the buyer of credit protection receives a settlement payment depends on whether a credit event occurs. Now note that credit default swaps protect one from more than just credit events that would trigger a payment. Because as we'll see, for the standardized contracts, North American CDS anyway, there's only two credit events: failure to pay or declaration of bankruptcy. But if a credit rating got cut, that would likely cause the cost of credit protection to rise. So if one had bought a CDS previously, and then the cost of credit protection goes up, not because of a credit event that would trigger payment, but simply because the market's perception of a worsening of the bond issuer's credit worthiness, that would mean the cost of credit protection would have risen, and consequently one could sell the CDS for a higher value than it was purchased previously. So CDS give protection from a wide range of credit events, but only a narrow number of them, again on the standardized contracts in North America only two, would be what they would call credit events. And credit events are also called triggers, triggering events, credit triggers, and even default. Understand when someone says default in the context of CDS, they don't literally mean a default. They are specifically referring to an event that would trigger a settlement payment on a CDS. So that's using language a bit laxly, but nonetheless, that's the way it's used. And as far as examples, we'll see a longer list of possible examples, but I'd mention the only two that are credit events under the North American standard contracts. And as to whether or not a credit event has occurred, that's up to the ISDA determination committee. So there are regional committees established by ISDA, and I'd mentioned them earlier in the session, although I've used just the acronym a few times. Again, ISDA stands for the International Swap and Derivative Association. As you might guess by the name, it's an industry trade group, and there are regional committees that will convene to decide whether or not some event constitutes a credit event or not. And if the ISDA committee decides a credit event has occurred, there'll be a settlement payment. Now, at the top of this exhibit, you see the method for computing the size of the periodic payment. The quarterly payment, typically quarterly, it's made by the credit protection buyer. So that would be the notional amount times the premium. And again, that's using language casually. It's more typically called the coupon or the CDS spread times the length of the period. And the buyer of credit protection would have to make those payments periodically, usually quarterly, until a credit event occurs. If it's a single name CDS, if it's a single name CDS, that means a credit default swap based on a single issuer, corporation, government, or government agency, the happening of the credit event would terminate the contract. And once the credit event occurs, there'll either be a cash settlement. That is, the seller of credit protection would have to make a dollar payment to the buyer of credit protection, and the value of that cash settlement would be determined via an auction conducted by ISDA with the CDS dealers in that region. So it's not a global market. If this happened in Europe, it would be amongst the CDS dealers in Europe. If it's in North America, the auction would be amongst the CDS dealers in North America, where they would be bidding on bonds that are deliverable if one were to choose physical delivery. But note, physical delivery is an opt-in. Cash settlement is the default setting, and so unless one opts into physical delivery, one would get a cash settlement. So just to illustrate briefly, let's say the notional amount of the contract was $50 million, and let's say based on the dealer auction conducted by ISDA, that auction process established that the value of deliverable bonds that had a $50 million par value, but after, say, the declaration of bankruptcy, they were trading at 75% of par. That's the 75% of 50 is where the 37.5 comes from. Well, that would mean that the seller of credit protection would owe the buyer of credit protection $12.5 million on that $50 million notional contract. If one opted into physical delivery, they'd have to deliver the $50 million par value of bonds, and then they would receive the full $50 million. So here you see a longer list of credit events. Note that Only the first two are credit events on the standardized North American contracts: declaration of bankruptcy or failure to pay. And not just failure to pay on one of the deliverable bonds. The provisions entail what they call, the provisions of the CDS entail what's called a cross default clause, which means if the issuer defaults on any outstanding debt security, that would be deemed a failure to pay for purposes of the CDS. Note, these additional items were commonly included as credit events in negotiated contracts. And we're starting to see some reemergence of negotiated contracts in the last year or so. But until recently, 95+% of all volume were in the ISDA standardized contracts. And while the majority of contracts are based on indexes, which we'll see in a minute, the split until recently had been about 80% in index contracts and only 20% in single name CDS. So there you see the reference I was making before, single name CDS. Sorry about that. Single name CDS, in other words, contracts based on a single issuer, not a single issue, a single issuer, and typically a range of bonds with different maturities of that issuer would be good for delivery if one shows physical delivery. But note, I said something like 20% of the volume over recent years has been in single name CDS. Close to 80% of volume has been in the index contracts. And so I think a subsequent slide has more detail on the index contracts, so I'll save that for a few moments. And basket contracts, I understand they're starting to make a little bit of a comeback, but a basket contract is where the buyer and seller of credit protection agree on a list of names of issuers to be included. Those were very common before the financial crisis. I understand that they're just starting to make a little bit of a comeback recently, but until just the last 6 months or a year, the vast majority of volume had been in either single name or index contracts. So we've talked about cash settlement and physical delivery, and since time is short, I'll not linger over that here. And here you see a diagram that simply illustrates diagrammatically what I had said earlier. If you choose cash settlement, then there'll be a money payment from the seller of credit protection to the buyer of credit protection, and the dollar amount of that payment would be established via an auction conducted by ISDA of the CDS dealers in the local region. On the other hand, if you choose physical delivery, the buyer of credit protection delivers the bonds having par value equal to the notional amount and then receives cash equal to the notional value of the contract. And the uses in general, well, you can reduce credit risk exposure by buying credit protection on bonds you own. And note, I'm not sure if there's an exhibit in here, so I should mention it. The index contracts that I had talked about earlier, note there's both an investment grade index as well as a high yield index. And the investment grade index, it's made up of 125 issues, not issuers, but specific bond issues. In the case of the high yield index, it's based on 100 issues. And these, since they're made up of specific bonds, they have to recreate these. These are indexes put together by Markit, the Financial Information Organization, M-A-R-K-I-T. And they come up with new indexes every 6 months. And that actually generates a lot of trading as people move from the previous index CDS to the newly minted ones, as there's much more liquidity in the newly minted ones. So one could buy credit protection as a way of reducing exposure to bonds they own. Sellers of credit protection are oftentimes institutional investors like insurance companies or pension funds that are selling credit protection as a way of generating income, because naturally the CDS spread is reflective of the credit risk, and that's naturally tied to expected return. So in some cases, selling credit protection is a little bit similar to going long the asset you're selling credit protection on. And a very handy use of buying credit protection is that's a shorting underlying credit. That's wrong there. That should say buyer, not seller. That is buying credit protection when you're not long the related security, the underlying security. You might say, well, why would one want to buy credit protection on bonds you don't own? It's a very good way of taking a short view, that is betting on a decline in value that doesn't expose one to the mechanical complications of actually short selling. Because when you short sell, that is sell something you don't own, naturally the buyer in the transaction is expecting to take delivery. And so that means when you sell something you don't own, you generally have to borrow the security to deliver it in satisfaction of the trade. Well, of course, in a securities loan transaction like that, the lender of the security can call the loan in on short notice, and as a short seller, you could be forced out of your position at a time not of your choosing unless you can find someone else to lend you the security. And so buying credit protection on bonds you don't own is a very handy way of making a short bet without the complications related to short selling, especially if one is short selling relatively illiquid assets. And this page is just summarizing some of those ideas. So since I've hit just about 2 o'clock, which is quitting time here, I'll wrap the session up, although I'm more than happy to take questions should anyone have questions on the issues we've just been discussing. So if you have questions, please ask away or type them in. Otherwise, I will hope you all got a lot of good information out of the session, and see you again next week, perchance.